Hey everyone, welcome back to my channel. I'm really excited today to be sharing about how you can get more rental properties. So, I work with a lot of people to buy their first property, and that's just the first step if you really want to be a real estate investor. So, the way I started out is I bought one property and then I bought another property. And in between, I had to save up the 20% because I didn't know any better. This was years and years ago. I didn't have anybody telling me, oh, there's different ways you can do this. So, after a while, I ran out of money. And so I was like, okay, well, and I started asking everybody I knew, well, how do you buy more properties? Where do you get the money? Well, of course, now fast forward many years, now I know there's all different kinds of ways to buy properties, but back in the when I was starting out, I didn't know that. So I'm going to be sharing with you today, going from one rental property to multiple properties. So let's get going on that. So the first thing I want to talk to you about is if you haven't bought a rental property before, or you've thought about getting into real estate investing, then you are in the right place. What I want to share with you is, kind of my journey where I went, and then also, how you can continue on with investing when you first start out. So without further ado, let's get going. All right. So, me and my technology things. I think this is what I need to do. Okay. So hopefully you can still see my head there. Okay. So first of all, you got to master the basics, right? You can't just go off and start, getting properties or start buying them. I mean, you could, and then people do it all the time. But what you want to do is make sure that you at least know the basics, right? And that's what I teach people. So your first rental property is like your first learning experience. It's like the first day of school. You're going to kindergarten, you're learning to tie your shoes, get into first grade, you're learning how to, write your name, that kind of thing. Now, so the first thing you're going to have to know about is your local markets. And that means wherever you want to invest, right? Not just like in your backyard. So for me, where I live at in the Dallas-Fort Worth area, I cannot invest in my own backyard right this second because it's just too expensive, right? It's just the market is still kind of crazy right now. But wherever I'm investing, what I need to know is what are the sales prices, because you want to know like what things are selling for so you don't pay too much for a property. You need to know the value. And then you also need to know what rents you can get for a property. So let's say you find a property and it's a terrible rental market, so you have to know, okay, well, what can I expect to make on this property? And then one thing that people forget about is how long does it take to rent? So one of the risk things I have on here is that if you buy in an area or a location that has too many rentals, what can happen is it can take way too long to rent your house. So if you don't know where to get this information, so I'm a real estate agent. So I like to look at days on market. How long does it take by the time that property goes on the market to the time it's going to get leased? Because you want to factor that all in as far as costs and holding costs and that kind of thing. And then, you do want to look at risks. Like, so if there's an HOA, is there going to be any problem having a long-term rental? We all know that in the short-term rental arena right now, there's a lot of HOAs trying to crack down on this. But I've actually managed and owned properties where the HOA wants all this information about whoever's going to be living in the property. So just check that out before you buy it. What kind of repairs is this property going to need? What's the age of the property? For rental properties, anything that was built before 1978, you have to have a certain certificate that there's no lead-based paint. It's very simple, if you have an older property, so that's nothing to get worried about, but just know that that's something you have to have a tenant sign off on. And then also check to make sure it's not in a flood zone. Now, I'm in Texas. We have very few flood zones, but we do have them, right? So you have to make sure that it's in a flood zone, and you can easily find that information out. And then, of course, you want to know, this is part of your analyzing the cash flow. Okay, so how much potential income can you make off of this rental property, including your mortgages and property taxes and insurance. And you want to calculate your expenses, include in the beginning utilities, because before you get that property rented, you're going to have to pay for all of that lawn maintenance and utilities. People forget about that. And then if you can, like when I started out, I had reserves. Somebody told me you should have 6 months of reserves for each rental property. Now that's a lot of money just to have in the bank. But just in case the reserves I'm talking about here is if it does take a little bit longer to rent the property, how are you going to pay for it? So that's what I'm talking about as far as cash reserves. Now, when you buy your first rental property, you might not have the best credit. Hopefully, you don't have bankruptcies or, the worse your credit is, it's just harder to get money. It's not that you cannot get financing for your rental property. You might just have to be more creative about it, which is something I also teach. But if you want to take that first rental property and leverage it to buy more properties, then you got to manage your debt, right? Your credit cards, your car loans. And when you can, you need to work on your credit score, because why? You're going to want to go to a bank and refinance this, or a credit union or a private money lender. It doesn't really, you won't want to use a hard money lender, but you're going to want to get a long-term note. And that's usually some kind of financial institution. And yes, they're going to look at your credit score, and they're going to look at your debt to income ratio. So you want to really kind of be mindful and building strong financials. It's not something you have to do right out of the gate, but if you're going to be investing in real estate, it's always just smart, because you never know when you're going to find a deal and you need to go get money, right? And if you have bankruptcies and foreclosures on your credit report, it's just going to be harder. It's not impossible, but it is going to be harder. And the financing options, the larger down payment. So the idea is that you're going to refinance this property and take out the down payment and buy a second property, or maybe buy two properties. Hard money lenders, I only use those when I have to get a property really quick and it's, I need to rehab it. There's always private money lenders as well. And the difference between hard money and private money lenders is relationships. So hard money, there's a lot of companies out there that do hard money loans. I would not suggest buying that unless you have a specific strategy that you can refinance out of that hard money loan pretty quickly, right? Because you don't want to, they usually charge, 12, 14, a lot of interest. Private money lenders are relationship based. That's also something I teach. So, and then of course there's creative financing strategies, but for this presentation today, this video, we're just leaving it to the basics, okay? Now, when you're buying a property, when you buy your first rental property, number one, you're going to talk about, I'm going to be talking to you about location, and you want to buy in appreciating areas. Why? Because you're going to want to refinance that property and pull the money out. Okay. That's really one of the most easiest ways to buy more properties. That's what the leverage is all about. So if you can buy an off market kind of distressed property, well below market value, you season that property, you make improvements to it, you get some steady rent, you rent it, get some cash flow, which is just, whatever income you're getting minus the expenses, you refinance it and take out the cash. And you know exactly what I'm talking about here, because I have a slide about the BRRRR method. So you can use your down payment for the next property. Now, when I got to my third or fourth, now this was a while ago. So, and the banking laws, it seems like they're always changing, on mortgage. I think they're getting right. We got high interest rates right now. And don't let that scare you. I hear people saying, oh, I'm not going to buy anything because, high interest rates. You know what? Don't let that stop you from buying rental property, because this is a long game, right? And so, and that interest that you're paying is helping you get that property, and it's also a tax deduction. Now, some people talk about home equity loans on your primary residence. And I have done that. I've taken the equity out of my personal home and I've used it to buy more properties. Now, that's a good strategy if two things. One, you have some kind of payment plan to get that home equity line, off of your house. You don't want that second mortgage there. So you have to have some kind of repayment plan. You usually can get pretty good favorable terms on a home equity line of credit. That's kind of what they're called. Right now it's a little bit harder. Not all banks are doing it. So again, depending on when you're viewing this and what's actually going on the market, but just know that there's other ways that you can pull equity out of the property. So the thing is, you want to buy it right? The very first time, you're going to buy that property right. You're going to look at location, the sales price, and is this a growing and appreciating area? Now, cash flow. Now, that seems like that would make sense. Like, okay, what is cash flow? Well, cash flow is what's left over at the end of the day after you've paid your property taxes, after you've paid your sorry about that, cash flow appreciate. It wasn't a glitch, right? It's basically at the end of the day, how much money are you really making on this property? So one of the things about pulling equity out, so if you don't have any equity and you're not making any cash flow, it's going to be hard to leverage that property, right? So that's why I'm kind of focusing on buying your first property. Now, there are people out there that have cash and they can go out and buy 10 properties. Okay, that's probably not you. And that definitely was not me. I had to do it one property at a time, right? One property at a time. I wasn't ever in a financial situation where I could buy multiple properties until I'd been doing it for a while, right? Now, one thing you should know is when you go to the regular financial institutions, credit unions, different lenders across the board, what they're going to do is, so let's say that you're just banking on the cash flow, right? You're just making a lot of money off of this property so they can see that the nugget is covered, the mortgage, the insurance, all the payments that you have. However, they're going to deduct, when they're doing they being the financial institutions are going to disallow 25% of your rental income. So they call it the vacancy rate. So even though you can show, 12 months of rental income when you're going to pull out the equity, they're only going to look at 75% of that income. So just kind of keep that in mind. I haven't really seen that change from lender to lender. They normally, I have never in my life anyway, never had a lender who gave me like 100% credit for all of my income. You want to track your expenses and income. If you have a CPA, a lot of times I'll use lenders that use the property as the collateral. So they might pull my credit, they might look at my tax returns. But the bottom line is that I don't really get caught up in the debt to income ratio on my personal, because as long as there's equity in the property, and what I mean is they're not going to loan you at 100%, right? They're going to loan maybe, I think the lowest I've ever seen is 70%. I usually play it safe and only borrow up to 80% of whatever the value of the property is. That just leaves me a buffer. So that's kind of how I do my business. Because you never know what's going to happen in the market, right? So you kind of just always have to be cautious in terms of being smart cautious, if that makes sense. Minimize your risk. And then you do want to track your income, your repairs, the cost of the repairs. Some are just, one-liners right off of the, bottom line, and others are going to be capitalized over the course, different repairs. Property insurance, property taxes. And if you do have a property manager, you'll want to factor that into your actual cash flow. Now, I talked a little bit about the BRRRR method. Okay, so that means buy the property, rehab it, rent it, and then refinance it. So that's a really good strategy, a very popular strategy. And it's another way to really leverage your first rental property or all your rental properties, right? Because once you start getting like 2, 3, 4, you are going to just have escalated wealth building, right? Because now you've got 3, 4, properties that are really, if you've bought them all right, you can just keep leveraging. And so what I was saying before about a commercial loan. So when I got to a point, I think I had about maybe 4 properties. And at that particular time, the banks were like, okay, you can only have 4. And so I found a lender, and this took me like asking everybody I knew, and they had what they called a commercial product. Now, I am talking about single family homes here, but they had a commercial loan where they basically wrapped the 4 properties together. I mean, the paperwork was about 5 inches thick. And then I was able to pull out all the equity from all 4 properties at the same time. And then, wow, I went on a spending spree. So you can do that too. Now, so the BRRRR method refers to buying a property that's undervalued, usually off market, that kind of thing. It's a fixer upper, right? You're going to rent it out and you're going to season it. Well, what do I mean by that? So that means you're going to have a tenant in there for 6 to 12 months. That's what seasoning is. The lender wants to make sure that you're, getting the cash flow and, it's all working. I have seen lenders that will see, consider a refinance at 3 months, but you usually get better terms the longer you can season it for 6 to 12 months. And you're refinancing it, right? That's how you pull out the equity. That's how you leverage it. So you're going to use those refinance funds to purchase that'll be the down payment on your next property, right? And you simply rinse and repeat. And that's how it's done. And when you start getting, 2, 3, 4 properties or more, you can bundle them, if you're going to keep them. Just remember there's a little exit strategy that goes along with that, but you can then really take out a lot of money at one time. And that's exactly what I did. When I had the 4 properties, I was able to take out almost like 50% of how they had appreciated. It was great because I went out I went on a little shopping spree. Now, again, that took time. I didn't do that overnight, right? I started out just like you are. I had to have the 20% because I didn't know any other way at the time. Now I know other strategies where I can buy properties and I don't have to have 20%. But for this particular strategy to work, you have to have stable rental income and you have equity. So remember in the beginning of the video, I talked about how you need to not overpay for a property, because when you're paying over, you're going to have to wait longer to get any equity out of that. Now let's talk about joint venture agreements. This is basically partnering up with different people to buy more properties. You pool your resources, you pool your money, your time, your skills. You can get more properties faster this way. You can leverage relationships now instead of the actual equity in the home. You can combine expertise and time. I've done several joint ventures and partnerships to acquire properties. Here's what I'm going to say about partnerships, though. Trust and transparency are paramount. So this is something you just don't go into business, so to speak, with somebody you barely know. Or for me, it would be like a brand new investor. There would just have to be, it's not going to be a 50-50 partnership if I'm, the seasoned investor and they're brand new, because I'm bringing more to the table. What are the financial commitments of the partnership, right? So I've been in partnerships where maybe I'm the private money lender and someone else is, going to handle the rehab. You have to have agreed upon exit strategy. So what do I mean by this? So typically I've done this in flip situations and owner finance situations, meaning that the partner and I, we flipped a property, or we had a partnership and we bought and set up owner finance, where we bought the property together, and then we sold it as an owner finance property. You have to have open communication. Now, I also have a blog post where I kind of go more into this, and I'm just going to share a couple stories for me personally where the partnership didn't work out so great, and sometimes it worked out really good. So I'm going to give you 2 examples. I did one. It was awesome. I was actually the private money lender, and the other person, we were doing a flip. It was basically a cosmetic flip. So I was the private money lender. So I lent the money for the rehab, and it just so turned out we were taking possession of the property subject to the mortgage, right? So we didn't have to actually have a down payment for the property. So partnered, I provided the funds, and then we rehabbed it. Took about 30 days. That my partner oversaw the rehab. I only went to the property a couple times, and then we listed it, sold it, and split the profits. And it was a beautiful thing. Made some quick money right there. But I've had other partnerships where we've done a flip, and the person I was partnering with, we got a third party involved. We got a private money lender that funded the deal. And my partner and I were not on the same page for repairs. So since I'm a real estate broker, I am pretty picky about and I know I'm going to be listing the property and I'm going to be selling the property. So number one, I don't take shortcuts, right? Yes, you can hire cheaper electricians and, foundation people and all that. But when I'm involved in selling a property, I'm not going to do that. So unbeknownst to me, the house had a fireplace. It was a fire hazard. That one didn't go well at all because we got stuck on the repairs. And it was the first time ever in my life that I have gone to a closing and I had to bring money, and that hurt. Now I only had to bring $2,500, but it hurt. And it hurt like, oh my gosh, I never want to do that again. So, and sometimes that happens, right? When you are doing joint ventures agreements, get it in writing. I can't stress this enough. and have a clause in there. Like if you're trying to do 50-50, have some kind of deal breaker in there. I've learned this. You got to have a deal breaker in there because sometimes you might not always agree. And then have a clause in the joint venture agreement where what if one person becomes incapacitated? They're in a car wreck, they're in the hospital for 3 months in a coma. You can't move forward because they're your 50-50 partner. So you have to have clauses. We don't like to think about, well, what if my partner passes away? What are you going to do with the property? So you have to think ahead and put it in writing because you never know what's going to happen. And then accountability. And when I say have an exit strategy, that's exactly what I'm talking about. Not like, are we going to flip it or going to own or finance it? But what if something happens? What if we have a problem? How are we going to get out of it? What if we start losing money because we hired the wrong contractor? What if it's taking too long? So how are you going to resolve problems? I guess that would have been a better way to say that. And then how are you going to hold each other accountable? And you just have to bring integrity and honesty to the partnership. And without that, I wouldn't do the deal. So you want to leverage your first rental. It's all about planning. It's about being financially disciplined. It's about having a strategy. When you have equity in a property and you have the ability to pull it out, what are you going to do with that money? Don't pull it out until you know what you're going to do with that money. Start small. Like I said before, if you're just, like me and you start out and you just want to get one property, then 2 properties. That's what I did. I started small. Learn from your experience. It's a great opportunity to really hone the skills that you already have. You'll find things you're like, oh, I could have done that better, or I could have asked the seller for this. I could have done an inspection. So build your foundation for growth. As your equity increases, it will be easier to finance additional investments. And that's what your end game should be all about. So real estate investing is for the long term, right? So sometimes, and I have, we all make mistakes. The problem is that you need to, educate yourself as much as possible and minimize those mistakes, right? But real estate is a long-term endeavor. And a lot of times, even if you didn't buy the property exactly right, or you didn't buy it exactly in the right appreciating area, over time, that can correct itself. It might be a year, might be 10 years, but real estate is one of those things that you're probably, unless you just really buy a bad deal, you're not going to lose tons of money if you know at least some what you're doing, right? So the success lies in you being patient to finding the deals, continually educating yourself, like working with someone like me, and you make informed decisions about how you're going to invest in real estate. Now, if you're watching this, you're like, wow, Nancy, I really want to start investing in real estate. So, you might be feeling stuck or just overwhelmed, or just how do you get started? So what you want to do is, you got to start somewhere. You can wait till tomorrow, but then tomorrow will always be an excuse. And there may be reasons that you kind of just have to have that honest conversation with yourself. Maybe you already have skills that you didn't even know would actually benefit you in being a first-time investors. And I talked to police, like let's just take police officers, firefighters, paramedics. They are day in, day out in neighborhoods. So a lot of us pay for information about, okay, where can we buy a property? Where's the vacant properties? They already know, right? They have the knowledge that we pay for. A lot of times it's our mindset. We have a scarcity, or we have I'm not worthy to be successful. And we sabotage ourselves even before we started. And, it's really not hard to find properties. What's hard is, and what people get stuck is the different strategies. And then they think, oh, I have to learn all these strategies. No, you have to pick one and you have to move on and learn that. And then, like, I started out with just buying single family properties. And, then I learned about property management, and then I learned flipping, and then I didn't flip my first house for maybe 5 years after I was already buying properties. So you kind of get into your own lane, if you will. And as you grow as an investor, as you start leveraging and you learn more, you are going to be able to build the wealth that you want. So I do have a workshop if you're interested in it. And this is even if you want to see if real estate investing is for you. So what we're going to go over is, just like I said, do you have transferable skills that other people are paying for? I'm going to give you a roadmap. I'm going to tell you exactly what you need to do from day one. That's the actionable guide starter kit. It's like, okay, what can I do today? Even if you don't have money, even if you have bad credit, even if you don't have support, there are things you can do right now to get started in real estate investing. And then what I really love is my first rental property planning workbook. And this really guides you through like, okay, how do I look for that perfect rental property? So give me a shout out at info@wallacelobsassociates.com for my next workshop, or just email me and let me know if I can help you. So I want to really thank you for watching today. And you can really help me by sharing this video, subscribing to my channel. And if you give me a like or a comment if you dig the video. I'm an old school girl there. And then I know this is what you want more of. So you can find me on Instagram and you can find me on LinkedIn. So connect with me. Let's talk real estate. I always have time for you if you have questions about real estate investing. Thanks again, and I'll see you soon.